Pressure, and that's putting some on alert about commercial real estate again. Let's talk about the sector in an outlook that now includes fewer rate cuts, of course, as well over the last 6 months. Joining us, David Steinbach, the CIO at Hines, Global Real Estate Investment Manager. David, thanks for being here on the Schwab Network with us this morning.
Yeah, thanks for having me.
So firstly, kind of the thing that stands out to me when I look at your notes and your analysis is that you guys are getting aggressive and you feel that this is the time to press in the market for commercial real estate. So tell me why.
Yeah, I mean, look, this is where we are now is really the end of over 2-year journey of interest rate increases. And, for monetary policy to shift 500 basis points, it's significant. I feel like the market has mostly digested a lot of that now, and we are beginning to see transactions start to occur. We're starting to see activity reemerge. Certainly, there's a lot of noise around those signals, and so we are being cautious as we do invest. But we have started to invest this year, so it feels a lot different than it did just 1 year ago.
What's the big change here? I mean, has the economy firmed up? Has the weak stuff been cleared out? Certainly, we did have a little pain trade there after the regional banks. Some credit had to get repriced in a pretty big way about a year ago.
Yeah, look, it takes the private markets. Private markets do typically lag the public markets, and so certainly in this cycle, the public markets were first down and are first to emerge back on the other side. And a lot of real estate investors, they've been coming from a place where their both fixed income and equity side of their balance sheet has taken a hit, but that obviously has stabilized, and recovery is well underway in those sectors, and that does ultimately trickle down into the private sector. I think what's also changing in the private sector is lender sentiment, but also an emergence of private credit funds, particularly here in the United States, and that's helping to plug some of the gaps that have been left in the banking sector. We're also seeing a lot of buyers emerge that are fully unlevered, and that's particularly in the multifamily space, where lot sizes are smaller, and those unlevered investors are moving now, and they are with anticipation that they will put leverage on ultimately. If they were to put leverage on in this moment, it would technically be negative leverage, but they can see the upswing ahead, and they want to get ahead of that.
So how much here also is about kind of keeping new supply under restraint? Is that helping kind of ease some of the pricing burden?
Yeah, look, in any market cycle, there's times when there's a strong build signal. There's times when there's a strong buy signal. Certainly, we're in a buy moment right now versus build, and a lot of developers, including ourselves, have across the board, slowed down projects, or they're waiting for a different environment to emerge, and so that really has created an opportunity on the buy side, which is where most investors right now, frankly, are focused. Ultimately, if you think about the real estate markets and how long it takes to deliver product, ultimately this is a good thing for buyers today. Supply is reduced, and that's really across the board. Meanwhile, we can see, for example, in the living space, the U.S. is about 3 million houses short. And so those structural undersupplies are still there. And so the fact that building has slowed down, frankly, will only feed into that further, which if you're a buyer today is a good thing. And I think buyers today are pricing that in.
David, looking at the stuff that you guys like, pretty easy to remember, little tool you've got, beds and eggs. Eggs, retail, beds, living, as you mentioned, part of the living there. What I don't see is office space, which I don't know what would be the rhyming version of that, but that still seems like a category that you're avoiding.
Yeah, look, in this last cycle, a lot of investors were focused on, they called it beds and sheds, which are industrial and living. Now, you could make the argument that we're shifting now. It's really beds and eggs, if you will. So eggs being something you need every day, and the basic necessities that you get from the retail sector. And when you look at specifically at the retail sector, it's been a long journey for that sector, and it's been 15 years where there hasn't been a lot of new supply. The winners and losers have mostly been sorted, particularly here in the United States. We're seeing that globally, frankly, in Europe and Asia as well. But we do see a big opportunity within the retail sector that just wasn't there before. Certainly living is still something that is, as we were talking about earlier, is interesting. What's also interesting about that space is, given the lease terms are so short, unlike any other sector within office, it's typically the first in and first out of a cycle. The repricing down happens quickly, but also the repricing up happens quickly because the tenants are marked to marketing every year in that sector. Office, though, is interesting. I mean, look, we've been talking about it for several years now, and it's no news that investors are concerned about it. What's interesting about the office sector is, number one, you have to look at it from a global lens. It's not the same everywhere, and certainly the dynamics in Europe and Asia are very different than the United States. I think that's one important point. The second point that we're seeing in our portfolio is this bifurcation between the best and everything else. And the best office projects really around the country, we're seeing a good leasing activity. And the best products are able to attract tenants, in some cases the highest rents that we've seen. So our occupancy rates and rents are strong, and that feels really good. But that is very different than how the capital markets are seeing it today. And so there's this split, if you will, that I think is where the opportunity is embedded, where capital markets is just painting too broad a brush right now of the sector.
David, what about rates? What role do they play? So far, that seems like your view has been pretty agnostic of rates. I think we've had this conversation. There hasn't even been really a major mention of rates as a key part to this, which I think is really interesting.
Yeah, I mean, look, we've been, keeping our eye on the Fed. Obviously, this year, with at the beginning of the year, I certainly had expectations that there would be some cuts, and a lot of folks have referenced the election, being a big driver of that. It is interesting when you look at U.S. election cycles and look at the last 17 of them. So this goes way back in history. Of the last 17 presidential election cycles, 2/3 of the time, the Fed has actually increased rates, and 1/3 is either held steady or actually cut. So that actually gives me a lot of confidence that the Fed is looking at this objectively, and even if there's a little bit of a rate cut, I think that's certainly still feeling like the sentiment. As I said earlier, though, I mean, this has been a 500 basis point journey for the industry, which is significant, and it's taken some time to digest that. And whether the Fed this year cuts a little bit or holds steady, it's just not going to really move the needle compared to what we've been through. So it feels like most of that pain is behind us, and now we're just trimming around the edges.
All right, really interesting take. Love the details. Helpful for us to try and figure out where to avoid the landmines. David, appreciate your time.
Thank you.
All right, David Steinbach, CIO at Hines, with a aggressively proactive approach in commercial real estate, with even some positivity in a few of the office areas as well.